and welcome back to the channel. And on today's video, we're going to be going over my 3 dividend stocks that I plan to hold for a long duration of time and that I am buying up a lot in. If you do enjoy the content, don't forget to comment, like and subscribe to the channel. And every time that we hit a milestone of 100 subscribers, all the way up until 2,000 subscribers, we have been doing giveaways. I did one just last week and we're already nearly up to 200 subscribers. So don't forget to get involved, and thank you very much for watching. So yesterday I spent a good deal of my day looking through my dividend portfolio and going over some of the stocks, and these 3 I have some really strong conviction on that down the line and in the future these are going to be solid companies with improving dividend payments and will continue to not only have growth in their dividends but growth in their actual share price. So the first one that we're going to look at today is Aviva. Who is Aviva? A leading UK insurance provider providing protection, wealth and retirement solutions to 18+ million customers. The 3 core business segments that they specify in the most is insurance, which is their main focus, life insurance, providing protection, saving options and retirement income solutions, general insurance, including coverage for vehicles, homes, travel and the businesses. They do wealth and retirement solutions, investment products such as stocks and shares ISAs, pensions and retirement planning tools, supports individuals in building long-term savings and managing retirement income. They also do asset management, which is overseas capital for both individuals and institutions, pension funds and stuff like that, and primary areas of focus including ESG investing, infrastructure and real estate. So whenever I'm looking into a company, I always, after I find out exactly what they do, the most important thing about a business before you invest in anything is who's running that business. In this case, her name's Amanda Blank and she is the CEO of Aviva. And she took over this as a CEO of Aviva in 2020 and she's been on a mission ever since. She simplified the business by selling off 8 non-core divisions, sharpened the company's focus on UK, Ireland and Canada, and massively strengthened Aviva's financial position. Her leadership isn't just bold, it's delivering. Amanda says Aviva has never been in a better shape, with strong momentum, untapped potential and a clear path for growth. She's not just about profits either. Aviva is the first major insurer in the world to commit to be net zero by 2040. Recognised as one of the most influential women in business, Amanda's legacy is already being written and Aviva's future is looking stronger than ever. And a little quote that she did in the earnings report was, Aviva has got off to a great start in 2025. We continue to trade strongly, serving our customers well, growing profitably right across the group and demonstrating the resilience of our diversified business in a period of market volatility. So when I looked at the Q1 for 2025, and again I've been invested in Aviva for some time now, and I always keep up to date on the reports and stuff as you do, but when I actually had a deep dive on this, it was a solid fundamentals to be fair. Their insurance premiums were up by 9% quarter over quarter, which is 2.7 billion last in Q1 and 2.9 in this one. Their wealth net flows are 2.3 billion, which is 5% of their assets under management. A little bit down from Q1 24, but we're still talking billions. Retirement sales are up by 4% to 1.8 billion, up from 1.7 billion last quarter, Q1 in 24. Protection and health sales is 126 million, up 19% from last quarter, which was 106 million in Q1 24. Now their Solvency II cover ratio is 201%, which is a big thing when you're in the finance stock. Now, what that means is for every pound they have to pay out, they have £2 to play with, which gives you Aviva holds more than double the capital required to meet its insurance obligations, which is also a sign of strong financial health and stability. Aviva beats profit estimates on insurance premiums, and they soar. Aviva says it's on track to more than double profits in its wealth business in the next 2 years after a 29% jump in 24. That's huge. And Aviva eyes future wealth growth as profit rises 29%. So the strategic moves that they're doing to shape in Aviva's future. So what are they investing in? What have they sold? What are they doing? So in December 2024, Direct Line Group there was an acquisition for 3.7 billion to enhance UK motor and home insurance market share. Now since that, which only happened 16 days ago, as you can see here, the UK regulation launches Aviva's Direct Line merger inquiry. This happens a lot in mergers and buys and stuff. It is a thing to stop monopolisation and things like that. So these are normal things that happen. So the regulator set a May 29 deadline for comments from interested parties regarding the transaction and July 10th deadline for its first phase decision. So it looks like this has been put on the back burner a little bit, and it might take a little bit of time to square it out and sort it out. But That happens sometimes with business, but they're looking to expand, which is great. The acquisition of Direct Line is firmly on track. Direct Line shareholders voted overwhelmingly in favour of the transaction, and we expect to complete it by the middle of the year. So it looks like that's going to be pushed back a little bit, but everybody's in favour of it. Everybody was for it. So it looks like it's a good thing for both businesses going forward. In 2024, Aviva made a bold return to the global specialty insurance game with a 242 million acquisition of Probitus at 1492, a key player at Lloyd's of London. This gives Aviva access to a whole new market of global, high-value insurance risks and opens a door to further growth beyond its UK base. Expanding, growing, that's what you want to see, investing in themselves. Now, a key thing that's always important in dividend stocks is some people just see yield, see it high, see this, and just think, yeah, I'm going to get money back fast. Not always the best way to look at a company. So as we can analyse this, it has a CADI rating of 5, which means the consecutive annual dividends increases. It means the number of years that the company has been increasing their dividends. Now, when you are in dividend stocks, especially UK, well, worldwide actually, you have to take into consideration that COVID did happen around 2020 and those types of things. Companies wasn't growing. So you have to take that into effect. Now, Aviva look like they've got a strong growth. They are growing. They're growing by 6-7% a year at the moment. And they continue to look like they're going to be growing that, as you can see in the bottom left corner there, for the foreseeable. The total dividend share, so the dividend cover is 1.9, which again, it shows how many times a company's earnings can cover its dividend. A ratio of 1 means all earnings are paid out. Aviva's is 1.9, so again, it shows strong sustainability. Makes people not have to worry about whether dividends are going to be being cut in the near future, but always something to completely always come back on and look at to make sure that strength is still in the company, because if there's not enough money there to pay dividends, then dividends gets cut and so does the share price. Then a big factor I'm always looking at when I'm assessing into companies is debt and financial positions. Now, finance, banks, they always, as you can see here, have a high leverage of debt ratio. It's just the way that they do. They're highly leveraged. So these guys have got a debt ratio of 0.9, which is considered on a high end of a debt ratio. But again, like I say, banks and insurers, they are highly leveraged. Their financial position, short term, they overcome their liabilities massively. Long term, their liabilities do overcome their assets, but again, highly leveraged because of it being an insurer and stuff like that. Now, looking to a company as well, you always want to see people buying shares and not always people just plummeting shares out, because it shows insider confidence and it shows investor confidence. And the shares bought over the last 0 to 3 months compared to shares sold, as you can see, absolutely great. A lot of money coming in. There's obviously money going out. That's just the way it is, but more shares coming in, more shares being bought than more shares going out. So overall, this shows me a really good health stock on this. I'm happy with what I see. I'm happy that they've got growth. I'm happy that they're investing. I'm happy that they're not over leveraging themselves. I'm happy that there's enough money in the background and dividends are well covered. So it fills me with confidence. And this is one that does hold 10% in my portfolio. And if you do like the pie that I use on Trading 212 for my dividend stocks, that will be in the description as well for you to take a look. But Aviva is definitely up there with one that I am buying more of in the future, and I'm holding this for a long term. This next stock, in my opinion, is an absolute sleeping giant. Gamma Communications. Who is Gamma Communications? So they're a cloud-based voice and communication service, serves SMEs to large global carriers, operates in the UK, Germany, Netherlands and Spain, and partners include Cisco, Microsoft Teams and Ericsson. So what is Gamma Service Provider? We provide number invoice and SMS terminations for large global service providers who do not have their own network, essentially being the backbone for a company's providing servers and being the middleman between the company and the end user. What does Gamma do? Now, these guys have a big involvement with the voice enablement with Teams, Microsoft Teams, and they've been buying up a lot of these businesses around the outside of this to support their backbone for growing further into Germany and other countries in Europe. So again, as important, every time I look into a company or hold a company, I want to know who's in charge. That's one of the biggest things that you need to have knowledge about before investing in any company. And the CEO is Andrew Belshaw. He was appointed CEO in July 2022, and he joined Gamma in 2007. He was a CFO from 2015 to 2022, and he has a background in finance and strategic planning. Played a key role in Gamma's European expansion and acquisitions, known for measured leadership style and a strong focus on long-term growth, which is great. It means he's been there for a very long time. He knows the expansion, he knows the acquisitions that are in play. Who do you want more in charge when someone that's been there for over 20 years? That's what we want to know. Well, nearly 20 years. So their 2024 financial highlights was a milestone year for Gamma. Revenue hit 579.4 million, growing 11% year on year. Gamma officially upgraded to the main market of the London Stock Exchange. Strong expansion across business, enterprise and Europe. Recurring revenue base and acquisitions powered continued momentum. So Gamma Communications was part of the AIM, which is a lower regulated stock market for newer stocks. And they've gone onto the main market now, the London Stock Exchange, to appeal to bigger investors. And they wanted to be more affiliated. And again, one thing that you're going to notice across this is they talk a lot about seats. Seats is end users. So if there's 5 people at a business and they're all using Gamma and they're all using an end-line phone, that's 5 users, 5 seats. So they're up to 1 million in the UK and they're up to just over 500,000 in Germany at the moment. And again, they are continuing doing a lot of growth into this. So their expansion blueprint. So Placetel, Gamma acquired Placetel, a leading German cloud PBX provider, significantly strengthening its presence in Germany. Placetel bought with it 260,000 active seats across 35,000 businesses, complementing Gamma's existing service and expanding its customer base in Europe's largest cloud comms market. Gamma takes fight to Vodafone and Deutsche Telekom with 165 million acquisition. Now, again, this is something that I do have to take into consideration because I do also own Vodafone, and Vodafone have been struggling for many years in Germany, to be fair. So this is something I'd need to keep an eye on from conflict of stocks. Starface, which they bought for £165 million. Gamma acquired Starface, a German provider of business communication solutions, to strengthen its position in the German cloud communications market. This added over 210,000 cloud PBX seats, bringing Gamma's total in Germany to over 500,000 or 500,000. They also bought, Gamma Communications also acquired Bright Cloud Group, which was another £30 million. And Gamma's acquisition of Bright Cloud, a UK-based cybersecurity firm, boosted its management security offerings, allowing it to provide enhanced cybersecurity service to its business clients. Now, they expect to keep growing their end users by Q4 2028 to 10.4 million, currently sitting at roughly about 5.3 million as a total in Q4 2024. Their expansion blueprints, that they already have some very key partnerships with Morrison's, with Swansea Council, with the AA and Edmonton's Electrical. Now they're 18%, so their adjusted EBITDA is 18% CAGR, and it was 23.1 in 2014, and it's 125.5 in 2024. Their continued annual growth rate is 19% on their adjusted EPS, which was 15 in 2014, and it's 85.1 in 2024, which is some great growth. So they got the business outlook, which is within Gamma's business, our service provider business is growing with potential for even higher growth. We are extending geographical range and capability in the SME space. SIP to cloud conversion is accelerating, increasing opportunity for high ARPUs. Their enterprise is also growing. They're really trying to expand themselves into Europe. They see significant opportunity in Germany. They're really strong for Germany at the moment. Again, I think it's probably because they see other business lacking so bad there or having such a hard time that they see an open window to get a great opportunity from. Their growth drivers is customers have required more complex communication solutions, and they feel that they have the solution to fix this. The German cloud market is still underpenetrated. Again, they see a vulnerability there that other people aren't seeming to fix, and they think they're the guys to do it. Now, delivering to the shareholders through the value through dividends. Again, they've got a CADI rating of 10 plus, so that means they've been improving their dividend for over 10 plus years, which is huge. They also have a dividend cover of 3.71, which means that they can nearly 4 times cover the dividend payment, which means there is a space for significant growth, and they've already been growing it for 10 years. Their dividend per share was 19.5, which grew from 17.1 pence to 19.5 pence. So again, as you can see on the chart at the bottom, they've just been growing their dividend massively, which is huge. And their insider transactions, which is another thing that I always like to pay attention to a company. Nobody's selling. And this isn't institutions or businesses buying into the company of more shares. This is actual individuals of staff or people that work there or people on the board, etc. They're actually buying shares, which shows confidence in it. And these guys were buying shares at £16.50 a share and 13, which is higher than what it is now, which means that when they bought that, they seemed nothing but confidence in it. And again, I think this is really undervalued stock. I think it's going to take a little bit of time for it to get there, but they're just huge. They've got huge upside potential, their financial strength and stability. So again, their debt ratio is 0.294. Now, they don't really have a lot of debt, but they picked up some debt from an acquisition that they did. But their assets, as you can see over their liabilities, is huge. Now, liabilities doesn't always mean debt as well, which also is classed as a debt ratio. It doesn't have to be straight up loans, etc., to be debt. Liabilities are classed as debt in the debt ratio as well. So in trading in 2025 has begun positively in continental Europe as a result of a strong trading performance of our recent acquisition in Germany, Playstyle and Starface, and we continue to make good progress with integrating both businesses. In the March results, we noted the challenging UK market conditions as part of the wider macroeconomic picture. Since those results, we have seen ongoing softness in the UK market conditions continue. In response, management has taken a number of prudent actions to manage costs. Underlying trading continues to generate healthy cash flows for the group, and the business is in robust financial position. Gamma had a net debt of 21.2 million as of 30th of April 25. This is after partially debt financing the acquisition of Starface and a share buyback program. The latter utilised 30.3 million of cash at the end of April. So again, these guys did take out some money to buy some of the acquisitions that they did, but having a debt ratio of 0.2 is phenomenal. It's really low. There's great growth there for their dividends. I feel like it's really undervalued at the moment. As you can see from the overview, they're trading at 50. Well, from analysts realise that they're 55.7 below the estimated of its fair value, and earnings are forecasted to grow 6.46% per year. Earnings grew by 30.2% over the past year, and analysts in a good agreement that stock price will rise by 45.6%. I want to be a part of that. Company looks healthy. This is showing nothing but green flags to me. So this is definitely one that I have put as nearly 10% of my portfolio, and another one that I'm going to be building a bigger position in going forward. This third and final stock I think is an absolute monster. It's one of my favourite stocks, and it holds the biggest position in my dividends portfolio, which is 20%. It's Legal & General. Legal & General is one of the world's largest asset managers. Legal & General Investment Management, LGIM, a division of Legal & General Group plc, is one of the largest asset managers globally with over 1.2 trillion assets under management. Clients across 37 countries, specialties in index funds, ESG strategies, pensions and fixed income, massive UK presence and growing footprint in the US, Europe and Asia. They manage money for the governments, pension funds, corporations and retail investors. Legal & General is one of UK's leading financial services and asset management companies. Founded in 1836, L&G provides life insurance, pensions and retirement solutions, investments management and long-term saving products. Like I say, with over 1.2 trillion in assets under management, which is absolutely huge. So again, massive thing before I get into anyone. Who's the CEO? Antonio Samoes, I'm going to say it. The current CEO of Legal & General is Anthony Samoes, who took over on the 1st of January 2024 from Sir Nigel Wilson, with a background at HSBC and Banco Santander. Samoes brings extensive financial services experience to the role. Since his appointment, he has led a strategic shift focused on streamlining operations and maximising shareholder value, including selling non-core assets like Cala Homes and forming key partnerships such as with Japan Meiji Yasuda. In his first year, Samoes earned 10.6 million in total remuneration, including a buyout from his previous role, highlighting his company's strong confidence in his leadership and vision. So in his previous role, he was actually bought out from his role, which is why his pay was so much. So if you're going to pay for someone to come and work for you, already that shows massive confidence in the CEO that you want to have on board. So the 2024 performance snapshot, again, these release their earnings twice a year. Most UK companies are only regulated to do that, so they don't necessarily have to do a full quarterly earning report like USA stocks. But so UK, some do, but some only do them twice a year. So a strong financial performance in 2024. 1.6 billion core operation profit, up 6%. 1.8 billion capital generation. Their balance sheet strength was 14.8 billion, store future profit. Their increased returns to shareholders, 21.36 pence per dividend, which was up 5%. And they also are doing a £500 million share buyback in 2024, which they did 200 million of. Now, a massive thing that we have to take into consideration here again is the solvency coverage ratio, which is 232%, which is massive. L&G's 232% coverage means it holds more than twice the required capital to meet insurance liabilities, a strong indicator of financial strength and shareholder protection. So again, we're looking for every pound that they owe, they've got £2.50 in the bank to pay it. So again, the asset management executing against our strategy, the 1.1 trillion in the global assets under management, and their 57 billion pound in the private markets in the AUM. So their expansion of our private markets proposition, which is the stuff that's not on the stock market. Fueling growth, rewarding shareholders. So obviously with the sales of some of the businesses they did the 3.6 billion back in dividends. They also did the 500 million in the share buy. So the total for 2025, is another 500 million in share buybacks. So this is from the sales of Cala Homes and other planes that they've sold and moved around. And they had $1 billion from the sale of the US protection business as well. The enhanced returns are 6% growth in core operation profits. That's 5% growth in dividend per share. Announcement of a new buyback of 500 million for 2025, which again isn't going to improve the share price. It's going to improve the business overall. Less shares in the market means more value. Returning 5 billion or 40% of the market cap within the next 3 years. Their institutional retirement, capital efficient UK PRT, which again in 2024 was 8.4 billion of the PRT volumes, which again is huge. A little bit down from the year below, but as a contrary of things across the board, they must have had a really good year in 23. So 24 still some really good numbers. So there's 12 1 billion plus deals in the 2025 pipeline, with 40 billion plus active UK deals completing in 2025. Massive. Record volumes in North America. So again, the 2024 execution, it's just been growing year over year, totaling out to 2.9 billion on the PRT. So 2 strong balance sheets committed to the business. Plans to accelerate our current growth trajectory and Legal and General to retain 80% economic interest in US PRT post-transaction. So they've got a new partnership with Amaja Yasuda to scale US PRD, which they sold 8% of that business, keeping 20% of it, which means that they're scaling. So their business moves of acquisitions and divestments, Legal and General, and deep in collaboration with 50 million renewable energy investment. So they're also Legal and General to buy 75% stake in property-focused investment Proprium Capital, which only came out 12 days ago from this 13 days ago from when we recorded this video. Their LNG sells US protection units to Japanese investor for 2.3 billion. Like I said, it was only 80%, I believe, of that they ended up selling off. And they also going to be taking a 5% stake in Legal and General. So the transaction biggest in LNG's history, says CEO. 2 companies will also form US pension risk partnership. And Legal and General sold Cala Homes Group for 1.35 billion, which happened earlier in the year. So their dividend growth and the payouts. So they are, again, since 2015, all the way up till 2025, they've been growing this dividend. It's been at a little bit of a slow rate over the last couple of years, but the fact that it's going in a positive direction is exactly what matters. Their EPS is 43 pence, which means that they've got a cover ratio of 2.1, which again means they've got twice as many earnings to pay the dividends, which shows that there's room for growth and that there's enough money in the bank to be paying their dividends consistently. So no stress about having to have dividend cuts, which gives you more reassurance. Now, the debt and the financial position overview. So again, this is a insurer type stock, Legal and General. So naturally, they have a higher debt ratio, which is 0.99, which again is on the higher side, but on a debt ratio, it's typical that it's going to be around the 1 ratio. The financial position analysis. Short term, their assets absolutely dominant liabilities. And then long term, they've got shorter assets and a lot more liabilities. But again, they've got a lot of the assets from the short term stuff too. And one of the big important things that we always look for when we're investing in these companies, that a lot of people aren't just selling sales like it's gone, selling stocks like it's gone out of fashion. Now the buys on Legal and General are through the roof. There's one sale of 645 shares in the last 9 to 12 months on record, and the rest are just absolute buys. And these are from individuals as well. These aren't institutions. These aren't big companies or funds. These are people inside the companies buying massive shares at a decent price, so they know that further down the line that this company is going to continue to grow. And I think with all the acquisitions and the moving around and how much they have the assets under management, I just think Legal and General has been stagnant price for a while. It's been flatlined, but I think going forward into the next few years, not only is the stock position going to keep growing, I think the dividends is going to keep growing as well, which makes me very confident in this, which is why it's got the biggest holding in my position, because the dividend is amazing that these guys pay. So yeah, these are my 3 stocks that I think see huge potential that I'll be holding for a long duration of time. And thank you very much for watching. And if you did enjoy the video, please leave it a like and subscribe. And don't forget to comment to be in with a chance of winning when we get to 200 subscribers and do the next draw. Is there any dividend stocks that you guys think are powerhouses that I should look into? And if you do like my pie, it will be there down in the description for you to have a look at and try in 212. And I'll see you in the next one.